Why are saunas, massage chairs, and, Kirkland's signature dog food driving billions in sales, while those chaotic, record-breaking lines at the gas pump are actually like a secret weapon for global customer loyalty?
I mean, it sounds like a riddle, right?
Yep.
But it's actually a masterful retail strategy hiding in plain sight.
Yeah. Welcome, everyone. Thank you so much for coming to watch the video today. We are really thrilled to have you here because we're unpacking exactly how they pull this off.
Exactly. So our mission today is to break down the Costco Wholesale Corporation Q3 2026 earnings call.
Right.
And that's covering the period that ended on May 10th, 2026. We are going to follow a very clear structure for you today.
Yeah, let's give them the game plan.
First, we'll provide a concise summary of the company's prepared presentation, detailing their financial results, future guidance, and some major strategic shifts. Then we are going to do a really comprehensive question-by-question breakdown of the Q&A session with Wall Street analysts.
Sounds good. Let's unpack this prepared presentation first, because when you look at the raw numbers here, it is just, it's massive. To truly understand Costco, you really have to wrap your head around the sheer scale of it all.
The scale is staggering. Let's look at the baseline financial results here. Net income hit $2.192 billion.
Roll.
Yeah, that is up 15% year over year with an earnings per share of $4.93. And net sales reached $69.15 billion.
Wait, $69 billion in one quarter?
In one quarter. It's an 11.6% increase. And if we look at comparable sales, which, measures revenue from locations open for at least a year, they grew 9.8% overall.
Right, which is huge.
Exactly. Even when you strip out the volatility of things like gas prices and foreign exchange, those comparable sales still grew a very healthy 6.6%.
And it's not just like giant pallets in physical warehouses anymore, right? Their digital sales surged 21.5%.
Yep.
But here's where it gets really interesting for anyone analyzing retail loyalty. The membership data. They pulled in $1.373 billion just in fee income alone. Total paid members hit 82.9 million, which is up 4.1%. But the real star here, the executive members.
Right. The executive memberships are up 9.6% to 41.2 million. And when you think about the underlying psychology there,
It's fascinating.
it really is. An executive member pays double the standard fee up front, right, to get a 2% reward later. It forces this psychological commitment to consolidate their shopping at Costco just to earn that money back.
Yeah, you have to justify the fee.
Exactly. And in the U.S. and Canada, their overall renewal rate is a staggering 92.2%.
Which brings us to arguably the most fascinating operational dynamic they discussed, which is the gas pump phenomenon.
Right.
So during this quarter, events in the Middle East impacted global supply and prices. And as a direct result of that, Costco actually set successive all-time company volume sales records for gas.
Yeah, the volume was unprecedented.
Right, and I like to think of Costco's gas stations as this, like, loss-leading moat. It's not just about selling fuel, it's a funnel. Think about it. You wait in that massive line, you secure the cheaper gas, and because you've already invested the time, you are just pulled right into the warehouse.
That's the exact mechanism at play. When global supply events cause prices to spike, highly price-sensitive consumers are searching for relief.
Right.
And Costco managed this demand, requiring multiple daily fuel deliveries to individual locations. The result is that many consumers utilize their gas stations for the very first time.
Creating a new pipeline.
Exactly, a massive new pipeline for that long-term loyalty you just mentioned.
Oh, wait, here is where I kind of have to push back a little bit.
Yeah.
They describe their philosophy on margins as first to lower, last to raise.
Right, that's their mantra.
But you'd think with all this record-breaking traffic and lines around the block, they'd pad their profits just a bit. Instead, their core-on-core margins actually dipped 9 basis points. So is that first to lower thing just a great PR line, or is it a genuine strategy?
No, it's a genuine mathematically proven strategy for them. A basis point is just 1/100th of a percentage point, right?
Okay.
So a 9 basis point drop means they are deliberately taking a tiny sliver less profit on each item. They did this specifically to invest in lower prices for members on everyday staples.
Like beef and eggs, right?
Exactly. They view themselves as their own toughest competitor.
And that obsession with lowering prices extends to how they deal with international trade, too. They address the IEPA tariffs, noting that they've started submitting refund claims to U.S. Customs and Border Protection.
Right.
And instead of just keeping that money, their stated plan is to return any recovered funds directly to the members in some form.
Yeah, whether it's navigating commodity costs or international tariffs, the strategy just remains relentlessly focused on funneling savings back to the consumer.
It's wild.
And looking ahead, their future guidance is aggressive. They're planning for 26 net new openings in fiscal 2026,
Wow.
backed by an estimated $6.5 billion in capital expenditures.
And the tech leaps they are making with that capital are pretty incredible. I mean, same-day U.S. delivery now averages under 45 minutes.
Which is incredibly fast.
Plus, they're integrating AI on their product pages, which is driving triple-digit traffic growth. But, and this raises a huge red flag in my mind,
What's that?
with AI streamlining the digital experience and same-day delivery getting so fast, does Costco risk losing that famous physical treasure hunt appeal?
Ah, right.
Because the whole brand was built on, you walk in for paper towels and you leave with a kayak.
It is a valid concern, and it's something Wall Street watches really closely. But so far, the digital and physical experiences are actually reinforcing each other.
Really?
Yeah, they aren't cannibalizing each other, which perfectly sets up our transition into the analyst Q&A session. This is where we see the market's biggest concerns addressed head-on.
Let's dive right into those questions. So Wall Street is notoriously hyper-focused on growth, which explains the very first question from Michael Lasser at UBS. He wanted to know, is the slightly slowing 4.1% membership growth a warning sign that same-store sales growth expectations should be lowered?
And Costco's response effectively poured cold water on that worry. They stated that a 4% to 5% growth rate is actually their normal baseline when they aren't opening major new international markets.
Oh, I see.
Yeah, they pointed to that 9.6% growth in higher spending executive members and the 7% overall fee growth as proof of the ecosystem's health.
So it's fine.
Basically, yeah.
Okay.
Comp sales remain perfectly steady at 6% to 7% when you exclude gas. No warning signs are flashing.
Good to know. That leads right into the margin question, which Simeon Gutman at Morgan Stanley asked via Pedro Gil. His question was, with core-on-core margins down 9 basis points, is Costco taking an aggressive value posture to steal market share?
And their answer was a resounding yes. They explained that they cycled a large LIFO charge from last year.
Okay, wait, let me pause and translate for anyone who doesn't spend their weekends reading accounting textbooks.
Please do.
LIFO stands for last in, first out. It's an accounting method where you assume the last items you put into inventory are the first ones sold. In times of high inflation, that creates a charge that hurts your bottom line on paper.
Right.
When inflation cools, that charge goes away, giving the company a sudden financial cushion.
Precisely. And Costco took that exact financial cushion and used it to aggressively lower prices on beef, eggs, and gas.
Just to widen their price gap against competitors?
Exactly.
Well, that aggressive pricing strategy actually triggered a related concern for Christopher Horvers at JP Morgan. He asked, is lowering prices ahead of cost declines just opportunistic or a change in market rationality?
Right.
And he also wanted to know why SG&A deleveraged by 3 basis points. And again, just to translate for you guys, SG&A deleverage just means their operating expenses, like paying employees and keeping the lights on, crept up slightly faster than their sales did.
Yeah, so to the first point, Costco responded that lowering prices early isn't a reaction to the market. It is a long-term strategic lever built right into their DNA.
They just always do it.
Yeah. And as for the SG&A deleverage, they clarified that it wasn't a loss of efficiency. It was purely driven by higher healthcare costs for employees and some centralized legal settlements.
That makes sense. Question 4 came from Oliver Chen at TD Cowen, shifting the focus to digital. He asked, how do you balance the new retail media push with member satisfaction? And are these big tech investments trade-offs?
They stated definitively that the member always comes first. Their retail media strategy, meaning the ads you see on their site, focuses entirely on personalization to save members time.
So not just spamming them with that.
Right, no spam. And regarding the technology and AI spend, they described it as capital light. Why? Because it pays for itself through massive checkout productivity and increased sales.
So it's an accelerator, not a drain.
Exactly.
Okay, question 5 is one that really gets into the mechanics of how a giant company manages its wealth. Chuck Grom from Gordon Haskett pointed out they're sitting on $35 per share in cash.
A lot of cash.
Yeah, so he asked, what are the plans for capital allocation or a special dividend? And separately, when do you decide to relocate a club?
So for capital allocation, Costco said CapEx for growth is priority number 1. After that comes regular dividends and stock buybacks.
What about the special dividend?
Well, while they're completely open to a special dividend, they explain the math. Because their stock price is much higher now than in the past, they need a significantly larger absolute pile of cash to match the historical yield percentages of those past dividends.
Oh, that makes sense. The stock is more expensive, so the payout has to be bigger to feel the same.
Exactly. And as for relocations, they said those are triggered when older clubs hit massive volumes and simply run out of physical parking and gas capacity.
They just literally outgrow the physical space.
Yep.
Now, before we get to question 6, we are about to dive into how Costco is responding to one of the biggest pharmaceutical trends of the decade, and how AI is changing retail math. So if you're finding this breakdown valuable, take a quick second to click like, share this video with your network, and subscribe to the channel so you don't miss our ongoing series covering these market shifts.
Definitely. Moving to question 6, Scott Ciccarelli at Truist focused on logistics. He asked, with competitors constantly increasing delivery speeds, will Costco build its own first-party delivery network?
I mean, I would think they'd want to own the whole pipeline, right?
Actually, no. Costco's response was that they are very happy with their third-party partners right now.
Really?
Yeah, they are consistently delivering in under 45 minutes with a stellar 4.8 out of 5 satisfaction rating.
Wow, that's high.
Yeah, they don't need to reinvent the wheel. However, they will continuously evaluate the situation to see if vertical integration becomes necessary down the line.
Keep their options open. Question 7 came from Jihan Ma at Bernstein, and it touched on the psychology of a crowded store. The question was, traffic seen below historical trends early in the quarter. Did gas inflation drive the late quarter traffic? And how do you grow traffic in stores that are already totally full?
This required a crucial clarification from Costco. They stated that warehouse traffic is actually up about 2% recently, stabilizing as people's basket sizes grew.
Okay.
But more importantly, they pointed out that gas station traffic is not included in their warehouse traffic numbers.
Oh, so that 2% is pure, inside the store growth.
Exactly. And to relieve those completely full stores, they're improving checkout technology and opening strategic infill locations nearby to absorb the overflow.
Without losing the customer.
Right.
Smart. Question 8 from Peter Benedict at Baird tapped into a massive cultural and medical trend. He asked, are there any recent behavioral changes from consumers? Specifically, how are GLP-1 weight loss drugs impacting categories?
What's fascinating here is the ripple effect. Outside of gas eating up more of the consumer's wallet, broader behavior is surprisingly stable. But GLP-1s are absolutely driving huge pharmacy market share gains for Costco.
And it changes what people eat, right? Because these drugs suppress appetite, people buy less junk food. But Costco's consumer packaged goods partners are pivoting so fast. Costco is seeing massive sales spikes in protein-heavy items.
Oh, totally.
Specifically, Kirkland's signature ultra-filtered protein milk, protein snacks, beef sticks. The consumer's biology is literally shifting, and Costco is right there catching the demand.
Exactly. They adapt so quickly. Question 9 was from Rupesh Paris at Oppenheimer, focusing on technology and retention. He asked, how is AI search specifically helping, and will these elevated fuel volumes last?
I love their answer to this because traditional search engines have always kind of punished Costco. If you search for a refrigerator on a standard search engine, Costco might look like $200 more expensive than a competitor.
Right.
But that's because Costco's price includes delivery, installation, and haul away, while the competitor charges extra for all of that later.
Right. The traditional algorithm just couldn't understand that nuance. Costco explained that AI search models can finally calculate and display Costco's all-in value.
That's huge.
It is. If you search for tires, the AI knows Costco's price includes road hazard protection. And as for fuel, they believe elevated volumes drive long-term loyalty. Their data shows gas customers visit the warehouse more often and renew their memberships at higher rates.
It's that funnel again. Question 10 from Greg Mellick at Evercore ISI focused on the broader economy. He asked, is inflation still running around 1%? And did gas penny profits slip in order to widen the price gap?
Costco clarified that overall inflation was slightly higher, in the low to mid-single digits. This was almost entirely due to gas and some resin and plastic costs impacting their non-food items.
Okay, but what about food?
While highlighting their diverse inventory, they actually saw deflation in eggs, produce, and dairy.
Wow, deflation.
Yeah. And regarding gas, their penny profit, which is the actual profit made per gallon, was higher year over year, even though they intentionally widened the value gap against competitors.
Wait, they lowered the price relatively, but still made more profit per gallon.
Yes. They achieved that through massive volume leverage.
That is just incredible scale. Question 11 came from John Heinbockel at Guggenheim, pulling the lens back globally. He asked, What does the international and Canadian warehouse pipeline look like for the next 3 years?
The pipeline is very robust. Canada has consistent, strong growth mapped out for the next 3 to 5 years. In Asia, their focus is squarely on China, Korea, Japan, and potentially Taiwan.
And Europe?
In Europe, they see significant runway for growth in Spain, the UK, and France.
Lots of expansion. And finally, question 12 from Chris Nardone at Bank of America. He asked, is the executive membership strength coming from upgrades of existing members or brand new signups? And how is the China executive rollout going?
Costco replied that it is a very healthy mix of both upgrades and brand new signups. And as for the China executive launch, it is performing well ahead of their initial company expectations.
Proving the model works everywhere.
Exactly. It proves that this loyalty model translates beautifully across completely different cultural markets.
So when we step back and synthesize everything, from the prepared presentation to that last analyst question, what is the ultimate takeaway for you?
The core takeaways are really striking. First, you see Costco's unwavering commitment to value. Whenever they get a financial windfall like a LIFO charge cycling out, they don't pad their margins.
Give it back.
Immediately. They use it to lower prices for the member. Second, there's this massive halo effect from gas demand. The pumps are acting as a global loyalty engine.
Yeah, that funnel is crazy.
Third, we are seeing rapid, calculated AI adaptation to mathematically prove their all-in value proposition.
Finally getting credit for it online.
Right. And finally, their merchandising agility is on full display with how quickly they capitalized on the GLP-1 protein boom.
It is an incredible machine they've built. Adapting to global supply chains, accounting windfalls, biological weight loss trends, all while keeping that renewal rate sky high. But before we go, I want to leave you with one final thought to mull over.
What's that?
If Costco's biggest traffic and loyalty driver right now is the chaotic gasoline pump, what happens to that incredible loyalty loop in a fully electric vehicle future? When no one needs to wait in line for gas, how do you pull them into the warehouse?
That is the billion-dollar question for the next decade of retail.
It really is. Well, thank you all so much for watching today. If you found this breakdown insightful, please click like, share the video with your network, subscribe to the channel, and stay tuned for upcoming content. See you next time.